so. Okay. So, you guys weren't here for yesterday. What do you want to go over? Do you want to just go through it all? How do you want to go?
Through it all, probably.
Yeah.
I think one part we didn't go through yesterday was microeconomic foundations. Maybe might be good to start there.
You know, I did do that one.
Well, specifically the financial product.
Oh, I didn't do that one.
Yeah, the financial product.
Okay, I'll get to that one. I'll see if I can move a little quicker this time. I have to do it.
And this is gonna be on Moodle,
Yeah, I already did yesterday's.
because I have class at 2:45, so I gotta ditch.
Okay, perfect. Okay. So A is model building and forecasting. Got it. Got it, okay. When building a forecast model, what are the first steps or questions that need to be taken? Somebody comes up to you and says, hey, I need you to forecast the return on equity for our stock. I need you to build a model. What's the first thing that comes out of your mouth?
What drives the model? When you need it?
Okay, hold on. So the first thing is what variables do you think drive return on equity?
Time period.
Okay, hold on. Let's just do them in order. One would be, what do you think drives the return on equity for our stock? So you just write it into the survey. Okay, and then what's the second question?
When do you need it?
When do you need it? Okay, and I would be writing these down.
Sorry, the first question was what?
First question is, well, what do you think drives return on equity? You turn the question back around onto the individual and you find out what they think. One, you got them bought in. Two, they've been around for 20 years and they should know that stuff.
Can I type this?
Yeah, absolutely. And I'm recording it too. Yeah, I highly recommend you tape and record all my stuff. Tell me when you're ready.
You can go.
Okay. And then what's the third question?
How much budget do you have?
Yeah, how much is it? Yeah, do I have any resources? Do we have the data? Do we have any resources? You know, when do you want to buy is the next one, right? That's the second most important is when do you need it? Because that's going to justify the budget. Right? If they say I need it tomorrow, then I need 3 people. If I don't have the data, then it's going to take 2 weeks. And I'm going to need 3 people. Okay, so that's really important.
Sorry, what was the second one?
The second one is when do you need it? And then and then the question is, do I have a budget? And do we have the data? There's a seat over there. So that's that. Okay. And then how do you determine the dependent and independent variable? Usually the principal, your hiring manager or your boss or your colleague or whoever's the sponsor of the project or your client is going to basically tell you what they want to forecast. And if you're a consultant and you're working for people, they may hire you and say, you know what, we really don't know what to measure. You know, why don't you've been in this business just as long as we have, why don't you tell us what metrics we should be looking at? Okay, and then you make the recommendation of what the dependent variables are that we should be forecasting. And then how do you come up with the independent variables? Well, first thing is you ask people within the firm and other experts, either in the firm or outside the firm if it's not a confidential project, and you basically ask them what independent variables that they think drives return on equity for stocks like ours. Companies like ours in the industry for similar product types, product lines, and that have been around for as long as we have. So that's going to determine, you're going to get some information from the independent variables, asking people. The second is you're going to go into the literature and go to the library and look at academic and industry research that's been conducted over the years, go through the peer-reviewed journal articles, and see if you can find research reports and research articles similar to the questions that were asked for your project, and see what they came up with over time. So I could go to ProQuest or EBSCO or the peer-reviewed journal articles and type in return on equity for small cap tech companies, and I can probably get it. They may a bunch of academics and industry people may have done some of that research. They published it in peer-reviewed journal articles over the last 25 years. Print those out, read the research, identify the variables that were cited over time in that research, and that creates the theory, you know, and the literature that will support the variables that should be in the model. Okay, and then you combine the two, the internal recommendations with the external references, and you build a model out of it. And then once you build the forecast model, you run all the regressions, you look at the t-tests for the independent variables, you look at the F statistic for the model, you look at the adjusted R-square for the model, you look at the p-values, you look at all kinds of other stuff, and if the model looks like it's doing a good job, then you back test it, and then you forward test it. And if it did a good job on the back test, and it does a good job on a forward test, then you basically run the forecast, make the presentation in front of the board of directors or investment committee or senior level managers. You make the policy recommendations based off of the results of the model, supported by internal validation by people internal to the firm, agreeing with your variables, agreeing with your assumptions, agreeing with your models, and convinced that your back test and forward test are accurate. Then you'll make the recommendations to the committee on whatever the information was that generated from the research. How many variables should be in the model? No more than 5. If you have more than 5, you'll get multicollinearity. How do you test for variable and model significance? You test variable significance using correlation. First thing I would do is run the correlation between the independent variable and dependent variable to see if there's correlation. Either it's positive, negative, or no correlation. If there's no correlation, then it's not a good variable. So I'd do correlation, and then the next I would do a t-test. To test the statistical significance of the independent variable against the dependent variable. And then once I filled out the model, I would use the adjusted R-square as a measure, and I would use the F statistic as the model statistical significance. The T statistics should be plus or minus 2. Okay, is what we're looking for. And then the F statistic, if you're around 5, it's doing a pretty good job. If you're between, if you're around 8, it's doing a good job. And if you're around 13, it's doing a great job. And if you're north of 13 to 15, the F statistic is probably picking up some multicollinearity and saying this is a really good model, but you got multicollinearity issues too. Okay. If you were experiencing multicollinearity in your model, and if you had 2 variables that were highly correlated, the dependent variable and correlated to themselves, how would you decide which one to keep and which one to throw out? Now, statistically speaking, just from a statistics standpoint, you would keep the variable that had the highest t statistic. Okay.
You keep the highest.
Well, I'm just saying, based on just statistics, you would keep the one with the high t statistic, but that's not the correct answer. The correct answer is you would pick the variable and keep the variable in the model that was cited the most in the literature. Because over time they're using different data samples. And if that variable keeps popping up every single time somebody does a study, then that means that based on the literature and based on the theory, that variable needs to be in your model. Okay. So it's based on theory, okay, and literature. And then what is internal validity? Internal validity is when people inside the firm buy off on your model and your approach and the results. The external validity is where you go to the library and you basically research in the peer-reviewed journal articles, and the variables and the model approach that you conducted was validated through independent peer-reviewed journal articles over time. So that's your external validation. And then internal is people inside with the experience saying, yes, okay, that totally makes sense. Okay. And you need both, actually. You gotta have people bought off on your model internally, and you need to be able to justify the model and the variables by using external references. And the top people I've always seen when they, when they're debating and up in front of people, they're just citing a half a dozen research articles that have been published prior to justify their case. So it becomes kind of interesting to watch. The next question, what is the size of the Federal Reserve's balance sheet? And how much money by banks are being held on reserve at the Federal Reserve? So at the peak of the financial crisis, in say 2010 through, let's say 2015, it was 4.5 trillion. In let's say 2016 to 2018, it's currently around 4.1 trillion. And then prior to 2007, it was around 500 to 800 billion. And then prior to the financial crisis, let's just use the 9/11. Prior to that, it was around 250 billion. So the Federal Reserve basically printed all this money to buy bonds through open market operations, to prop up bond prices and drive interest rates to zero, to stimulate the economy by lowering the cost of capital, and try to stimulate consumption by individuals and investment by businesses. Okay. So that just, if you look at the graph of the monetary base, it goes like this, like 30 years at 250 billion, and then all of a sudden, 2007, 2008 hits, and it goes like that, just warps it. And actually, we'll find out later that the stock market and real estate prices kind of go like this around the monetary base. And so stock market price, we'll talk about this later. Stock market prices and real estate prices are highly correlated to the monetary base and money supply. We'll talk about that later. What has been the growth rate in the money supply since 2007? So these are reserves in the balance sheet of the Fed. Then 2007, money supply growth. In 2007, let's say to 2011, was around 30 to 40%. And then let's say 2012 to 2015, it slowed to around 8% to 10%. And then 2016, 2018, the money supply right now is growing at about 5%, 2%. So the money supply growth is slowing significantly. And stock prices and real estate prices in the economy are highly correlated to money supply growth rates. So if the money supply is starting to shrink or starting to slow, then that's going to put a crimp. That's going to take out liquidity from the economy, cause interest rates to go up and cool the economy, or maybe even potentially send it into a recession. And then the other model that I didn't put up here was GDP real times inflation equals the velocity of money times the money supply growth rate. This is called the quantity theory of money. Now I was just racking my brains for years because GDP, the target by the Fed, is 3%. And historically, over the last 10 years, it's been 1.7%. So the Fed wasn't hitting its target until recently. Now it's like, what is this, 2Q18 is like 4.1%. So for the last 10 years, they didn't hit their target, but recently they did hit their target. Got it. So my problem was, it's like, why, what's there's something wrong here, okay, in the equation? Because inflation, the target is 2%. Over the last 10 years, it's been like 1.5%. And currently, the GDP deflator, which is the Fed's measure, or the core inflation rate, which is what the Fed targets along with wage growth. Currently, it's the GDP deflator is at 2%. Core inflation rate's at 2%. And the wage growth is at 2.9%. So they weren't hitting it over the last 10 years, but yes, currently they are hitting their targets. Okay. So then, what I said, okay, if I hold inflation and velocity constant, this is the number of times currency cycles through the economy on an annual basis. You could need M1 or M2 measures of currency. So if they were growing money supply at 30 to 40%, then you think there would be a direct impact on real GDP, okay, or inflation, but there wasn't. So the question is why? Okay, well, it's pretty obvious. They're growing this at 30%, we relax that, and they're still not getting GDP to grow, then it's gotta be velocity. So as they were growing, the money supply velocity was collapsing, so there was no impact on GDP or inflation.
Velocity, you just mean like how fast the money's going through the system?
Yeah, it's like if you take all M1, M2 that's currently in the economy, it's how many times does it turn over? So it's like a turnover, inventory turnover type of thing.
Because
And
people were just
usually
holding on to their money, they were scared of losing
Yeah,
it.
exactly. And usually the velocity is around 9 times in a normal setting, but it collapsed to around 6. And I don't know where it is right now, if it's come up or something like that. But velocity is highly correlated with labor markets, employment, labor participation. It's like the number one factor. And then you have like shadow banking and electronic fund transfer and all this stuff where the Fed can print all the money and it goes out into the globe and there's no accelerator or multiplier effect associated with it. So that's what I was trying to get at here. So has the Fed hit GDP targets? Yes. Right. They're targeting 3, it's now 3.1. Yes. Did they hit unemployment? Unemployment currently is what, 3.8? Something like that. 2Q18. Their target's 5%. So the answer is yes. They've actually exceeded their target in that one. And then the CPI rate, we already talked about that.
That was the 1.5.
Yeah, it's been 1.5 over the last 10 years. Currently it's at 2%, and wage growth is at 2.9%, so yes, they've hit it and they've exceeded it. And the question is, if we were to fall into a recession, there's some shares over there too. If we were to fall into a recession, would the Federal Reserve use negative interest rates?
Yeah.
And the answer is yes. We've already said. If you kind of look at the yield curve during the recession, it was like, what's the yield curve? And interest rates never went below 0. But if you go to Japan and Germany, the curve is like that. So they have basically negative But they did drive their interest rates negative. We did it, we had a zero bound, we had a negative interest rate policy. We had a zero interest rate policy.
So we've never used a negative interest
No,
rate policy?
no,
But would we?
yes, yeah, we've already set that. And then the question would be, what would be the impact on the economy if you drove interest rates negative? Well, it would be stimulative, right? Because we know that if I use the capital asset pricing model, as a expected return or a cost of capital, this is basically the I that I'm going to use to discount to get the value of the stock. So I just use a simple model. And well, if risk-free rates go down, what happens to the expected return? If risk-free rates go down, what happens to this? It goes down. And then what happens to this? If this goes down, this goes down, this goes. Okay. So what would be the impact on the economy? It would be stimulative if there was negative interest rates, because people would be able to borrow at very low cost of capital. Okay. What would be the impact on asset prices? Well, as the risk-free rate goes down, the cost of capital goes down, and expected returns go down, and it causes stock and real estate and bond prices to go up. So the asset prices would be propped up. Okay. For savers are in bad shape, because if I'm retiring in 5 years from now and the interest rates are negative, I'm basically buying a bond at a negative interest rate, which is basically a tax to hold the bond. Okay, so I'm paying to hold liquidity, basically. So they're worse off. Okay. And then investors would be better off, because as the risk-free rate goes down, their expected return goes down, and the asset prices are propped up. Okay. So investors would benefit, and investors have benefited the most in zero interest rate environment over the last 10 years. So if you were lucky enough to hold bonds and stock and real estate, you're doing great. You've probably seen your money double and triple and quadruple over the last 10 years. But if you didn't, if you were in a socioeconomic or demographic group that didn't participate or own any of these capital assets, you were probably seeing your standards of living go backwards, because your real purchasing power for your wages have been eroded due to inflation over the last 10 years. So those guys are. And then businesses would benefit also through lower costs of capital. So the CAPM equation can also be used for the equity cost of capital. So as risk-free rates go down or turn negative, and that's going to drive the cost of capital for the equity and the debt down significantly, which means that corporations can borrow in the equity markets and in the debt markets cheaper. Okay. And that's what they've done over the last 10 years. If they loaded up on debt and they've bought back a lot of their stock. Okay, so that's that one. Any questions on that? You can take pictures of that before I erase it. Okay, everybody comfortable? Space. Okay, and I'm also recording this too. How are you today? Okay. Any more? All right, so the next question is the yield curve dynamics. Yield curves are extremely important. They drive the cost of capital up and down. Now, let's just start with the yield curve. It's upward sloping, maturity. Above, this is yield and maturity. think the yield curve is one of the most important things to watch. Because all debt and equity securities are priced off the yield curve. So if I'm gonna issue a 5-year bond, I'm gonna start with a 5-year treasury yield and start tacking on risk premiums to come up with the cost of the debt. If I'm gonna buy a finance, the development of a new building, those buildings usually last like 20 or 30 years. I'm probably gonna look at the 20, 30-year US Treasury yield and then start with that as my cost of capital and then add on some risk premiums to get to the cost of the debt or the equity at some point. So this is the maturities could be 3 month, 6 month, 9 month, 1 year, 3 year, 5 year, 7 year, 10 year, 20 year, 30-year bonds. We usually don't issue a lot of the 20 and 30. The 10-year treasury is the benchmark interest rate, probably the most important interest rate out there, because all personal loans, business loans, student loans, everything's priced off the 10-year as an index interest rate. Bonds that are less than 1 year, money market, and bonds greater than 1 year is called the capital market. Okay, what forms this yield curve? Well, it's the Fisher equation. Which basically states that nominal interest rates is a function of the real rate plus inflation expectation. Real rates of return really don't change that much. They're more cyclical and secular, so they really don't change that much on a daily basis. So the majority of the movements in nominal interest rates comes from inflation expectations. So if inflation expectations go up, then nominal interest rates go up. If inflation expectations go down, then nominal interest rates go down. So if investors, bondholders in the marketplace, which is the biggest, capital market or bonds. They're in the, 100 trillion. It's huge. So if all bond investors, bondholders have a view that inflation expectations are going to go up in the future, then what that will do is that will shift up the yield curve. Because the yield curve shifts due to higher inflation expectations. And if all bondholders for each maturity think that inflation expectations are going to fall in the future evenly across the curve, it's going to cause the yield curve to shift down. So what would shifting of the yield curve, how would that affect asset prices? So again, I go back to the basic cash flow equation. Divided by the interest rate, and actually in bonds, the coupon interest is constant, so it reduces to the perpetuity model. So this is the value of the bonds. We could also even do the Morgan growth model to get the value of stocks. And I'm using earnings per share there, as the coupon interest. But if interest rates go up, then bond prices are going to go down. If interest rates go up more than the change in the, greater than the growth rate, stock prices are gonna go down. If inflation expectations go down and interest rates go down, the bond prices are gonna go up. And if interest rates go down, expected returns go down and stock prices go up. So the yield curve will have a direct impact on the value of asset prices.
So if the growth rate increases higher than the,
Yeah, so
interest
this is
rate-
a little, so this is kind of your delta. Right? So for the stock equation, let's say the interest rates are gonna go up 2%,
Mhm.
and the growth rate is 2%, it will have no effect on the valuation. But if the interest rates go up 2%, the growth rate is going up 4%, and the growth rate of the cash flow is going up faster than the increase. And the interest rates and stock prices will go up.
Mhm.
Okay, it's when interest rate changes, interest rates go up 2%, but the growth rate's only 1%, that's gonna cause the stock prices to go down. So that's kind of the relationship. Okay. Using the Fisher equation, what variables drive risk-free rates, nominal interest rates on U.S. Treasury securities by maturity up and down, real returns and inflation expectations? Shifts the yield curve up and down, inflation expectations and real rates, and flattens and inverts it. Ooh. Okay. That's the next one that I like to see. Is the 3. So there's what, the normal curve. Upward slope, normal. And under an upward sloping yield curve, nominal interest rates equals the real rate plus inflation expectations, and inflation expectations are positive. Under a flat curve, nominal interest rates equals the real rate plus inflation expectations, and inflation expectations are 0. And then under an inverted curve, nominal interest rates equals the real rate plus inflation expectations. Inflation expectations are negative. Okay, this is what everybody's talking about right now. Okay. Everything is in the literature right now. So as inflation expectations start to rise, then your yield curve starts to flatten. And then your worst case scenario is as inflation expectations start to increase, not only does the curve flatten, but it starts to invert. And once it inverts, that's it.
That's your inflation expectation.
Yeah, it's the number one thing. These are the signs. So when you have a normal curve, there's a very low probability we'll go into a recession because people are forecasting economic growth and inflation in the future. Okay? So it keeps it positive. But as the economy starts to overheat on the short end here, then the curve starts to flatten. Because the Fed's pushing up interest rates to cool the economy down, to make sure it doesn't overheat. And then usually the Fed oversells the bonds on the short end, inverts the curve, and then that's basically the precursor. The people who have bonds in the future are actually forecasting negative inflation due to a recession. So the inflation expectations actually turns negative.
So that means you wanna get rid of your bonds?
Now you probably want to sell off short-term and buy long-term.
Okay.
So you rotate out short-term to long-term, okay, which is what people are doing right now.
Are we going towards recession?
I'll get to that in a minute. All right, so what are the three yield curve theories? There's actually 4 yield curve theories. expectations hypothesis, and basically that's the Fisher equation and the discussion of inflation expectations impact on the yield curve. And the other one is market segmentation. Preferred habitat. And liquidity preference. And actually, these three are related to each other. Because the theories basically state that the yield curve isn't just one one set of interest rates. In markets, it's actually segmented into three markets. It's segmented into the short term end of the curve, the medium term portions of the curve, and then the long end of the term structure. Term structure and the yield curve are used interchangeably. People say the long end, or the long end of the term structure, long end of the yield curve, long end of the curve, short end of the curve. That's kind of that's how they'll talk. And basically these theories say that the bond market is segmented into basically three segments: short-term, medium-term, long-term segments. And there's supply-demand dynamics for each segment. And then the preferred habitat basically states that there are borrowers and investors in the bond market that prefer to either be on the short end, prefer to be in the middle, or prefer to be on the long end. I'll be there in a second. And then the last one is liquidity preference. If I'm looking to get some interest on my money, but I need the money in 3 to 6 months, I'm not going to be buying 5-year bonds or 10-year bonds. I'm going to be buying maybe 3 and 6 month notes. Okay. And if I'm a pension fund or an endowment, I don't need the money right now, but I do need a bunch of money when my pensioners start to retire in 10, 20 years from now. So I figured out the actuarial tables of those liabilities, and I need the asset maturities to match the liability maturities. So if I have a bunch of people retiring in 10 years, I'm going to buy a bunch of 10-year bonds. They're all going to come due in 10 years, so I can be paying out the pensioners. Same thing with the 20 and the 30. So they have liquidity preferences. Yes.
I was just gonna ask, so the money market is 3, 6, 9 months?
It's 1 year or less. So the maturity is 1 year or less.
Oh, so it's inclusive of 1 year?
It is less than 1 year.
Less than, so is 1 year a part of either market, or is it it's just the year?
It's just a year. So less than a year, that's money market. Greater than a year, that's the capital market.
Okay.
Okay. And stocks are considered the capital market. And bonds with maturities greater than 1 year are also in the capital market.
Okay.
Okay.
And then your preferred habitat is both gonna be based on how liquid you wanna be, but then also
The first is the bond market segments basically by short-term, medium-term, long-term maturities.
or inflation expectations, right? 'Cause
Yeah,
you-
the expectations, hypothesis basically says that movements in the yield curve are due to changes in inflation expectations. And then the other three theories basically say, well, the market is segmented, by short, medium, long term. Some investors and borrowers prefer to be in one of these segments. And then a liquidity preference says that borrowers and lenders, like corporations are dominant in here, and then pension funds and endowments are dominant out here. Okay, any other questions on that? All right, show the equation and graphical representation of a normal upward sloping curve, a flat curve, and an inverted curve. What are the 4 yield curve theories? What impact do movements and shifts in the yield curve have on asset prices? So if inflation expectations go up, interest rates go up, and bond prices go down. When inflation expectations go down, nominal interest rates go down, and bond values go up. And we talked about the relationship with stocks. So that's basically what ours looks for. How does the Federal Reserve influence interest rates? through open market operations. This is the tool that they use. And basically, open market operations through the Federal Reserve Bank of New York buys and sells bonds. This is kind of how I do it. Buys and sells bonds, driving bond prices up or down, interest rates up or down to stimulate the economy or cool the economy. So when they buy the bonds, bond prices go up, interest rates go down, and that stimulates the economy. When they sell the bonds, bond prices go down, interest rates go up, and GDP is cooled down. That's kind of how I do it. That's how I learned my economics. If the Fed buys and sells bonds, what is the impact on bond prices? Well, if they buy bonds, bond prices go up, interest rates go down, and the economy is stimulated. If they sell bonds, bond prices go down, interest rates go up, and that cools the economy. Does the Fed control and influence directly short-term or long-term interest rates or both? They directly impact through open market operations the short end of the curve. So the Fed directly impacts the short end. But if the Fed sells off the bonds, drives interest rates too high, too fast, and inverts the curve, and it's going to send long-term interest rates down and the economy into a recession. So the Fed directly impacts short-term and then indirectly influences medium and long-term rates. That intermediate macroeconomics. There. Dynamic yield curves. What are your overall observations of the relationship correlation between the yield curve and the S&P 500 since 1998? And since 1998, basically, if this was the S&P 500, it kind of went like this, right? And then now it's kind of down off here like that, right? And if you look at the yield curve, normal, flat, inverted. So it would invert. It would invert, and then 1 year later, the S&P 500 would peak. Invert. So once the curve inverted, stock market peaked almost every single time. Normal, flat, invert. Normal, flat, and who knows when it's going to invert. So every time, 1 year, the curve would invert within less than 12 months. And this is all empirics. So once the curve inverted, less than 12 months, the stock market peaked. And once the curve inverted, in less than 24 months, you were in a recession. So right now, the difference between the 1 year yield and the 10-year yield is like 25 basis points, a quarter of It's the flattest it's been in 10 years. And if the Fed raises interest rates one more time, the curve is flat. If they raise it one more time after that, then it's slightly inverted. And if they raise another couple more times, at some point, the curve's gonna be inverted. And they're saying at the end of next year. So if it's at the end of next year, and it inverts in 2019, then when does the stock market peak?
2020.
2020, and then when are we in a recession?
2021.
Okay. So that's what we're looking at every day.
Which is right when we get jobs.
Yeah, that's why you gotta know your job times. Get them early. Seriously. Okay, and I think that answers that question. So the correlation between the yield curve and the S&P 500 is negatively correlated, right? Because as the yield curve increases, and interest rates increase, then the stock market's gonna go down at some point. Okay. Did the curve lead or lag the peak in the market? It led the peak in the stock market. If it did, by how many months? By 12 months. Did the curve flatten or invert? Well, it flattened and then it inverted prior to the peak, less than 12 months prior to the peak. On the short end or the long end of the curve? The short end. So the yield curve goes like this, shifts up, shifts down, flattens, inverts, goes back down. So it goes like this. Okay, it doesn't go like this. On this side, it goes like this. So it flaps around like that. Okay, so that's the theory. All right. Okay, can you use the yield curve to predict stock market peaks in a recession? Yes. By how many months?
Well, 12 months
Yeah.
for the peak and then 24.
Yeah, it's the terminology is really less than. So if the yield curve inverts, the stock market peaks within less than 12 months after that, the inversion. And then we're in a recession in less than 24 months. And those are all averages and stuff. Okay? You guys want to take a picture of that? Tell me when you're done. You done? Do you need to do this anymore?
Does it always bottom out at the same spot?
The stock market?
Yeah.
Well, in the financial crisis, after the financial crisis, yeah, if you look at actually the last two cycles, they set up a support line and a resistance line. We're in uncharted territory. And they all kind of oscillate like this. So this is uncharted right here. We've never been there before.
So we might set up a new support line then.
Maybe. We hope.
Ideally, otherwise a lot of people are gonna lose a lot of money.
Yeah, because coming off here back to here, that's like 70%.
Yeah.
We lost a lot of money in the last downturn. But if you look at GDP growth rates, if you go back in time, the economy contracted on average around 2.5% historically. In the Great Recession, it was 5%.
So a normal recession would just be 2.5.
2.5% correction. In the last recession was negative 5%. So it was 2x. Right? It was 2x.
Which was,
2 times.
was that in 2000?
That was 2008 through 10.
That was because housing prices and everything,
It was a lot of things. But that was, so it was, the last financial crisis was twice as bad, just on an amplitude standpoint. And then most of these recessions last around 2 years on average, but this one lasted 4 years. So it was twice as deep and twice as long.
So you can argue that you could predict, so say we finally invert and we could predict how much the economy contracts, we could use that model to kind of.
Yeah, I wouldn't use historical 2 and 2.5s. I would probably use something in between because we're in uncharted territory. Okay. And there's still financial systemic and systematic risks out there on the institutional side that have been addressed, but some of the speculation hasn't been addressed. The Fed kept interest rates too low too long and created asset price bubbles and home prices, bonds and stocks, and everything's overinflated, particularly on the investment side.
How bad do you think the next recession is gonna be in comparison to the financial crisis?
I don't know, things are playing out, aren't they, with the trade stuff? Who knows if the Democrats come in and get control of the House and the Senate and start impeachment proceedings. The market's probably not gonna like that. So that could be, that and the trade stuff could be, along with rising interest rates, could be a trigger. But kind of at some point, just, it's the straw that broke the camel's back. And that's usually how it happens. And it happens quick.
So with the recession.
Hold on, not too many because we gotta keep on
Okay,
track.
okay.
Okay. Dynamic supply demand, oh no, this one. Capital and commodity markets, so I'm looking for stocks, oil, gold, bonds, US dollar, foreign currency. So where's the Dow right now? Where's the Dow?
Down,
I'm just trying to test you to see if you're tracking the market.
down 181 basis
To what?
points. Sorry?
To what?
26,562.
26,522, there you go. Is it up or down?
62.
62, it's down.
Okay, 62, it's down for what, the day? What about for the week?
It's up,
What about the month?
it's up,
What about the year?
it is up.
So kind of the direction. And then the question is why? So, interest rates, growing economy, GDP, low employment, or low unemployment, wage growth, earnings growth, higher profits, blah, blah, blah. Okay, just some reasons. And then where's oil today? Like 80, something like that, going to 100. Okay, so this morning. So where is it? Over the year? So it's been going up. Why? Demand. And some of these factors that you can put in here, you can also get from your supply demand analysis. Right, so these two are actually related to each other. And then, OPEC constraints, blah, blah, blah. Where's gold?
It's up 1,203.
230. It basically over the last year been pretty flat. 3 months up. Why has it been flat? Well, no real inflation. And then basically relative geopolitical. So you can just use some of the stuff in this. I'm just trying to see if you're reading and tracking the markets. It shouldn't be a long question. And then where's the 10-year treasury yield?
It is up at 3.08.
3.08, so almost 1. Almost 3.1. Is it up or down?
It is up.
Basically, it's up. Why? Expectations. They're up. And then sell off. That's been selling the bonds. Just, quick answers. And then where's the dollar to the pound?
1.31.
1.31. Is it up or down?
It is up barely.
Up. So if it's up, then that means that the pound appreciated and the dollar depreciated. This is probably for the week, but for the year, the dollar's appreciated, now it's been depreciating. But it's been a long appreciation. And then where's the dollar to the euro? Is it like 1.13, something like that? 5, something like that?
1.7 today.
1 point what?
Today it's 1.17.
Yeah. And then you just tell me, you know, is it up or down recently, why, and then in the longer terms. So I'm trying to get you to be able to understand what's moving it now, but also the week, the month, the year, so you get some historical context to start tracking these markets. And then sooner or later, you're gonna just follow these things every single day. And then when the stock market crashes, it's gonna be, oh, my parents moved.
If I study the numbers tonight, and I go in tomorrow and put tonight's
It doesn't
numbers
matter,
in
it's all
that month,
relative, I just wanna
Okay.
see, it's not gonna be that much,
unless there's a massive.
I just wanna see if you know, if you're tracking them at all, you kinda
Okay.
know where they are, relatively speaking. Okay, okay, any other questions on that? Okay, did anybody wanna take a picture of that before I erase it? I didn't expect so many people. Are you guys all comfortable?
Yeah.
I just thought this would be kind of a different place to hang out. I like boardrooms, they're fun. Okay, dynamic supply demand analysis. I usually start with supply and then do demand. I set up the graphs. Supply, demand, supply, demand, supply, demand, supply, demand. Equilibrium points. Q. Equilibrium. Equilibrium. Price. 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 And got it. Okay, and then I'm gonna do stock, oil, gold, bonds, and USD. And remember, this is value, not price. Then first thing I want to do is to shock the system. S1. So the supply curve is going to move back. When the supply moves back, and prices go. That would be a reason for stock prices to, the supply curve for stocks to go back.
Stock buyback, reverse stock split.
This is the main one. And most stocks don't split, reverse split, so it's really immaterial. This really. Okay, any others? That would cause the supply curve to go back. Okay. That would cause the supply curve to shift out. IPOs, initial public offerings. Seasoned offerings, which are also called secondaries. Those are basically the ones that there might be other ones there, I'm just trying to get through this. Okay. Okay, so we got that. Okay, Okay, so what would cause the demand curve for stocks to go up? Quantity demanded, shift out, the price of stocks to go up. Well, I'm gonna buy stocks if I think that they're gonna give me higher return over bonds. GDP, growth, and if there's less risk in the market. These are just some factors. You may have other factors on your list that I've already given you, but those are some of them. Is any others on your list? Okay. What would cause the demand curve for stocks to go down? Causing stock prices to go down. Lower interest rates. So, one would be recession. Another one would be low GDP, wage growth. You can almost flip these things. High market risk. Volatility. High rising interest rates. And there may be some others on the list too. What would cause the supply curve to shift back for oil? OPEC. Cutbacks. I think Iran, right? Iran got taken out, didn't they, on the nuclear deal? Is there like an embargo? What about a war in the Middle East? Maybe the Straits or Hormuz, that would do it too. Disruption in the supply chain. What would cause the supply curve to shift out? OPEC. Action. Actually, Iran added a lot of new production and it was taken back. New supply would be also due to technology, fracking. Also pushed out the supply curve. Anybody else? Okay. What would cause the demand curve for oil to go up? Higher global GDP. Production. Anything else? Cause the demand curve to go down. Recession. cause the supply curve for gold to shift back, according by central banks. Central banks hold gold. Is there anything else out there for that on your list? I really can't, maybe you can come up with something. Okay, what would cause the supply curve to shift down? Extracting technology, discovery, other types of, what do you do? Don't you melt the stuff down and then put it through a foundry and something, who's our manufacturing person here? That could shift it out, extracting and discovery technologies. Or how about just sell off? Sell off, people selling off their gold, that would inject in the system. And what would cause the demand curve to go up? High inflation. Devaluation of the currencies. Fear. Risk. Geopolitical. Would increase the demand for gold. Any other factors? Will cause gold to go down, demand to go down, low inflation, currency, valuation, peace, less geopolitical risk. Anything else? About, maybe a recession. And then maybe boom, economic boom, and bubble, asset price bubbles. Okay, bonds, cause the supply curve to shift back. Budget surplus. Right, maturing bonds. I guess those are the two that I came up with. And then what would shift the curve out? Budget deficits. Foreign sell-off. Bonds. What would cause demand for the bonds to go up? Fear. Need for safe assets. High stock market risk, recession, low, falling prices, and interest rates. What would cause the demand curve for bonds to go down? You just flip it. Nice. Investment in higher yielding assets. Low I mean, if you know one side, you can always flip the other. And then what would cause the supply curve for dollars? This is a hard one. Still have a hard one on this one. So what would cause the supply of dollars to shift back? So I would say low money supply growth. Right. So the Fed is selling the bonds and pulling dollars out. Selling bonds, pulling dollars out. Selling bonds, pulling dollars out. So selling bonds, pulling liquidity out of the system. Those are what I got. What would cause the supply curve to high money supply growth, buying bonds, thereby injecting liquidity, and then foreign sell-off. Okay, what would cause demand for the dollar to go up? Higher returns. Stock, bonds, real estate. Would cause the dollar demand to go up. Safe haven. Capital flight inflows. Right, safety, the US dollar. Lower, narrow inflation. Rates. Lower, higher labor productivity. Higher interest rates. Yes, sir. And then what would cause the, and then obviously you can say economic or GDP growth. So what would cause it to go down? Recession. Lower returns. Stock, bonds, real estate. Capital outflows. High. High inflation rates. Low. Low labor productivity. And low interest rates. Okay, so there might be some on the list that you have, because things change. That's pretty much it.
So is this essentially just like, the supply side is like, what would cause each of these things to like increase or decrease supply?
The blue are all the things that would cause the supply curve to shift.
Okay, yeah, gotcha.
The green would cause the supply curve to shift out. The blue would cause the demand curve to shift up, and the green would cause the demand curve to shift down. It's the way I've kind of learned it, that way I think and I try to do stuff in color, because it makes it easier to, just makes it easier. And I got really good grades in my economics by doing this stuff. Made it really easy for the professor to do the grading. Plus I like to, I just remember stuff and I get stuff in color. Okay, you guys want to take a picture of that? How are we doing on time?
It's currently 3:20.
Oh, good, we're right on time.
Next will be the financial quick.
Yeah, I'm gonna read through that stuff, and then I'll do the last two graphs. Because I don't want to spend like a half hour writing it. Are you done here? So this flows right into your memo. This logic flows right into your memo, and then when you're reading the articles around these asset classes, these are a lot of the things that they're talking about. Okay. So the memos are awesome, because they're econ, microeconomics, this stuff's all goes right into the memos. Your derivatives that you're learning flows in the book in chapter 20. And then you're doing data analysis and technical analysis with the bullets and the charts. It's an application. I was told by people that my students need to be able to write memos. You should see the thing I did last night. I was asked to do a research piece on real estate investment trust security funds. I found like 360 of these funds, and I did segmentation analysis and broke them down by global and non-global and ETFs and so I did all kinds of segmentation analysis, and I basically used the exact same memo format that you did. Boom, memo, date, to, from, REIT fund, fee structures, listed them, 1, 2, 3, 4, 5 points. Boom, sent it off with the Excel spreadsheet. Simple. It's just I use it all the time. Because people don't want reports, they just want bullets. And tell me what you're doing, what are the results, and give me backup information. So I can read it in 20 seconds and get it. That's it. Okay? So the financial product innovation. So basically, what are the environment factors or events that cause, did everybody get everybody have pictures of this stuff? Okay, so I'm looking for the list, right? Yeah, so the first thing you're gonna do, does everybody get a picture of this?
Is that the financial product innovation?
Yeah, I did it in class.
Oh, it's online.
Yeah, it's online, you should get pictures. That one, the one I did in class was actually really good.
Is the second part of the exam with like all the number problems, is that online too? Like the answers?
Yeah, I sent them.
It is online? Okay.
Did I send them to you?
They're in the
When
email.
did you send them? Yeah, there are, yeah.
I turned them on.
When did you check?
Yeah.
I think the host is pretty
Yes,
sure
right.
anyway, right?
Yeah, but no, I think I did send them to
You
you.
have to go in and change.
And they should be on there. It should say quiz, in-class, student in-class quiz solutions.
Okay.
So after we
And
do
if they're not up there, just let me know.
after we do the online portion, we do the second half.
What online portion?
Or is all of this online?
The first part is not, that's what we're going over now.
Okay.
So solutions to the second part is up there, but we also run over in the class.
What I'm saying is the second part going to be part of the quiz.
Yes.
And we're going to also do that online.
No. No, everything's done in class. Yeah, I'm gonna hand out to you on,
You gotta see it. See it, right? You love these things.
where is it? Where am I at?
No.
No, I'm looking for the stuff I handed out.
Do you want
The
me to
agenda.
send them a chat to them?
The
Yeah, for this week, oh,
Yeah,
Legitimate,
do
yeah.
you have it?
yeah.
Tomorrow, I'll switch
Do you have the
it.
stack?
I do not have the stack, you just handed out one.
Oh, here it is.
Did you try to switch out our group?
No, it's not tomorrow.
Okay, you have to eat my final.
Yeah, okay.
Charlie Justin, this is what the exam.
This is the agenda for the week. There's no confusion. Okay?
1:45.
There's a study session.
No, I'm just telling you this.
Oh.
Yeah, all day.
Yeah, that doesn't happen to the right.
I think at 1:45.
Okay.
Okay? So you come in, I give you a blue book and an exam, put all your stuff down, and then you just leave. Go study, come back, give me the delete. Okay? It's pretty straightforward. I'm just trying to get you to remember this. I'm not trying to assess you, just trying to get you to learn. Okay? Okay, so basically the product innovation, the financial product innovation development. The key is you have to be constantly environmentally scanning the environment, constant environmental scanning. Because you're gonna have competitive pressures to change, and then since finance is so regulated by the government, there's gonna be regulatory changes. So those are gonna impact the organizational structure. So then you gotta rework, okay? So to be able to have an environment, a culture, company that actually can create financial product and process very rapidly and bring it to market very quickly, you have to be doing these environmental scans. You gotta understand the industrial psychology of your company. Okay? How do people interact with each other? How do they work with each other? What's the group thing? What's the group psychology? What's the individual psychology? And then you have to look at the organizational, the org chart of the company and see if it matches the market. And if it doesn't, you need to restructure the company. You need to have cultural leadership within the company, like charismatic leaders in management that will work as role models for the creative people in the company. You have to have role models. Then you have to have clearly defined strategy, tactics, and operational plans. So that's the first requirement. The second requirement is you have to constantly product and process innovate. And you got to be able to capture all of that knowledge. So you need an enterprise resource planning system, ERP, to be able to capture all of the product development and all the resource allocations that you've done over time, so that when the market changes and you need to develop a new product, you go get the people who developed the last product similar to that, and you go into the knowledge base and pull out the case study so you can develop the product and the process very rapidly and bring it to market. Okay? So you have to have that knowledge base in place. You got to recognize the needs of your clients, and those are going to be coming from the marketplace. You got to have a R&D, research and development arm, that is constantly product and process developing. And I know a lot of companies that don't have that because it's expensive. But the really good companies have R&D arms. They can develop the products with the attributes that solve the problem, that meet the needs, that solve the wants of your clients. So that's the second requirement. The third requirement is to actually produce the product and manufacture it, and then to be able to distribute it through existing or new distribution channels. If you don't have a distribution channel, you're going to have to build it or buy it. If you have existing distribution channels, then you need to figure out the optimal distribution through those channels and those networks, and then optimize it and be very efficient in distributing the product. So you need channel distribution, networks, and then you got to figure out the mix. You're also going to have to do supply chain optimization and figure out what suppliers are going to be feeding you the inputs that you will need to be able to manufacture the products. So So that's the third requirement. The fourth requirement is business development, marketing and sales. You're gonna need individuals that can develop new businesses, that can market the products, and then sell it, okay?
What about the sales cycle and velocity for the previous one?
Yeah, I'm gonna get to that. Okay. First thing you need to do when you do the marketing is you gotta segment the market. You gotta do the marketing research and then segment the market. And look at what market segments you're targeting, and then customize the marketing and products to those market segments. And then optimize them, not only the marketing mix and the channels, but also the product mix. Okay, with that, because it's all profit maximization. Then you target those markets based on psychographics, socioeconomic, demographic, or economic factors, either by industry or size of the firm, size of the family. And then you design around the marketing, you design the advertising campaigns to target those segments, to sell into those segments to generate fees, particularly assets under management, that's what we go for, and or commission, or other sales commissions from the sales. Okay? You have to be able to prospect clients, and you need to convert them from prospects into clients. Okay? And then you need to lock them in. And once you lock in those clients, you then now have recurring income forever. Okay? And that's what everybody's trying to do. Then the next step is you need the sales cycle. You got to be able to prospect, identify the prospective clients. You need to reach out to them through advertising and marketing campaigns. You got to get them to respond in some way, some behavioral way. You need to then have people in place to follow up with those inquiries, to then talk or meet with those individuals, to find out their needs, their fears, their greed, their wants, and then to be able to present them with the solution and close them. Once you've done that multiple times and you know how to run through the sales cycle very quickly and effectively, then you upsell and cross-sell to those same clients. And you basically sell, I can do 10 $1 million life insurance policies, it's gonna take me 2 months. It would take me 2 months to do 10 $10 million policies. So it's the same amount of time. So once you get the retail market down, then you upsell and start selling into the institutional marketplace. Okay? Where you're doing the same sales cycle, but on the institutional level, okay, not at the retail level. And then the next step is customer service. You need to be constantly in contact with your client, you need to follow up with them, you need to build a relationship with them, you need to listen to them, and then feedback any product defects or new product ideas or new wants or new needs that they may have back into the system as a feedback loop to then be able to sell them more product going forward to solve their needs. And most people in financial services, their number one need is retirement, okay, or death, okay, or poverty. You know, is what they're trying to avoid, okay, in most cases. There are two models, there's the S-curve and the product adoption cycle. Everybody gets my S-curves messed up. Because I've seen them look like this. Those are not S-curves. Okay. Those are not S-curves. S-curves are technological innovations within the company. So there's little curlies, like SpaghettiOs or SpaghettiOleos or whatever. And this is time. Right here. So if you can develop these technologies consecutively over time, then the marketplace is going to reward you and give you money, buy your bonds and buy your stocks. If you can do this. This is the technology. Oh no, I take that back. This is time. This is time. This is technology. Okay. And then if you can do that, like IBM and Salesforce and Cisco and Oracle and Apple and those guys have done this over time. What you're going to do is you're going to create an upward revenue growth path or a cash flow growth path. And if you take the cash flow, T plus N into the future, divided by the expected return on the client, minus the growth rate in the cash flows. If I can maximize the growth rate in my cash flows consistently over time by introducing new technologies and processes, I'm gonna max the value of the firm. And that's the objective. The other, and this is the S curves. And this is how we analyze different industry segments. And then the next one is the product adoption cycle.
How long can each of these periods last?
Well, just look at the iPhone, right? The iPhone was introduced here, and then the MacBook, the Apple computer, blah, blah, you know. So then they had, and now what they're doing is they're creating new S-curves. I don't know what the next phone's gonna look like. What would be the next revolution, or the next technological jump in handheld computing? I don't know, maybe a chip in your brain or something. You can store and take pictures and listen to music from your brain. I don't know.
I thought there were like a bunch of companies are putting a bunch of money into augmented reality, which is like
Yeah, that would probably be one segment.
Self-driving.
But who knows, maybe your phone becomes some kind of augmented
yeah, I thought it was like
reality space.
glasses to where like you look at someone and you have
Maybe.
like their profile and like this, that.
Maybe, I don't know, there's
That's
some,
Black Mirror.
Black Mirror,
That's
dude,
Black
I was
Mirror
thinking
stuff.
it.
The financial product innovations and financial engineering, everything we just went over about markets and distribution, are we going to have to write all of those?
I just want you to, you know, memorize that as best you can.
Okay.
Because basically this is a capstone for you. You're not exposed to this integration, you know, of these concepts. You're usually not exposed to these concepts until the end of your program. You know, so this is just an opportunity to learn this stuff now. So hopefully it'll add more value to your program. Okay. So what we're trying to do here is project out the revenue to figure out the valuation. Okay. And this is what firms are doing right now with unicorns and stuff like that, why they're paying billions of dollars for these tech companies. And this is the marketing literature. So all products go through these phases. First, it's the innovator stage. So you're losing money, you're burning through cash, your product's not adopted yet, you're not making any money, you're burning a bunch of cash. And then now through handheld technologies and social networking and other types of forms of outreach, boom, my product takes off, and we move into the early majority. Adoption phase. And at this point, your revenues and your costs are growing exponentially and maybe even growing vertically. And then at some point, everybody who wants your phone has bought your phone. The product starts moving into majority adoption phase, where your cash flow growth rates are growing at a decreasing rate, increasing at a decreasing rate, so it's your second derivative. And then it's gonna be late majority, and then laggard. And some companies basically follow this cycle, and Sun Computers, I mean, Atari, you name it, there's companies that have just gone bankrupt because they basically held on to just one product through the whole cycle, and then they just gone. Okay. So really the goal of this thing is to be able to constantly innovate new products consistently over time, and then again create this upward cash flow growth rate path. And if you can maximize the growth rate in the cash flows over time, then you're going to maximize the value of the share and maximize the value of the firm. So you got to be able to do it over and over again. And that's where branding comes in, right? Oracle, Salesforce, Apple. I've done it over and over and over and over again. And that's why you're paying, I don't know, what's Apple now? $800 a share or something like that. Or is that Amazon?
Amazon's over
Amazon's
1,000
up.
now.
1,000? I thought Apple was 50. So that's it. And then the last piece is what you're learning right now is financial feasibility. So if you,
Some of that.
no, I bought
Gets
Apple.
on there.
Oh.
Yeah, Apple's at 220 now.
Food app?
So the next thing is before you enter into developing these new products, you gotta figure out how much it's gonna cost. How much is it gonna cost me to develop this product, right? So if I can figure out the cash flows, right? Cash flow 1, cash flow 2, blah, blah, blah. If I can figure out the cash flows, right? And then discount those cash flows back. Right? You guys are learning this, right? Well, you discount these back to get the present value of what those future cash flows are gonna be. You subtract out the cost. If your net present value is positive, then you're gonna do it. Okay, and if your break even is less than 3 years, you're gonna do it. You're gonna do it.
Didn't it take Amazon a long time to get profitable though?
It did.
Like 10 years? 12
Yeah, but the investors were patient.
Yeah. So like then for Tesla, it's been like similar amount of time, obviously, some outside.
Yeah, but they're not Amazon.
Yeah, exactly. That's what I'm trying to figure out.
And actually, the Audi and BMW and a lot of those competitors are coming out with electric cars too. So they're gonna take their market share.
Yeah.
So you think Tesla's gonna go bankrupt?
I didn't say that. Somebody will probably buy it.
What about SpaceX? Is he?
He'll probably sell that off. Hi, Mary Co.
I'm just watching something.
Cool, yeah, absolutely. So again, you have to do the financial feasibility around the new financial products to see if it's even feasible to do it. And you're gonna apply the capital budgeting techniques that you're gonna learn in class, okay? And then the last is the exit strategy, number 7.
Yeah.
So number 7 is rules-based. Enter. And exit. So you have rules that basically say if these criteria are met, we're gonna enter the marketplace and we're gonna develop the product. And at some point in time, we generate successful products and a brand consecutively over time, and we're maximizing the cash flow. At some point, you're gonna have a rule that basically says, okay, maybe we should exit the market. Either we're not getting the profits and the cash flows we want, so we're gonna sell off the division. Or what you can do is you say, I'm gonna keep the division, because it's generating cash flow. For the firm, it's generating internal cash flow, which is cheap, so we're gonna keep it. Or what we do is we say, okay, it's met all this criteria, we're gonna spin out the company and take it IPO and create a capital event during that, doing it that way too. Okay. So a lot of these VC guys, they use, some of them will use metrics to enter and exit a market. Some of them will just use gut feel to do it. Because some of them have been, like Kleiner Perkins, has been so successful, even though they've lost probably billions of dollars and failed companies, they've made billions of dollars in successful companies. So they've won more than they've lost. Okay, so that's that one. And then what's the next one? How we doing on time?
About 15 minutes.
Okay. Anybody want to take pictures of that?
I'm sorry, this rules-based is the final step of the
That's the final
product
step.
development.
Once you do the feasibility analysis and you decide you go or no go, okay? Then let's say you go, right? You go. The question then becomes, when do we get out?
Okay. And the
Okay.
feasibility is kind of part of 7, or is it more part of the, well, yeah, I
This is
guess it would be,
6.
right?
Yeah, so first this is 6, this is financial feasibility.
Got it.
If you decide to go, then you decide, okay, this criteria needs to be met, we're gonna enter the marketplace.
Okay.
Then at some point in time, once we've entered, we go, okay, are we gonna stay in, or are we gonna get out? Are we gonna
Okay.
keep it, are we gonna sell it, Are you gonna keep it or spin it out as a new company? So you have to have exit strategies that
Okay.
create the capital needs. And the question is, if you can do this over and over again, you're gonna be a multi-billion-dollar company like Oracle and Salesforce. But in our space, it's Goldman Sachs, JP Morgan, B of A, Wells Fargo, US Bank, maybe US HSBC out of the UK. There's all these financial, now we got fintech companies that are doing all this stuff. Okay.
What was the new fintech company that you were talking about the other day?
Oh, that was good.
Kate, you guys take a picture of this?
It was during Financial Club. You said that you were trying to get someone from that company, a new company.
Oh yeah, I was trying to get a bunch of them. They couldn't, none of them would come because they're all going IPO. So they're too busy, they can't come visit us. They said, once we go IPO, we'll come visit you. But they'll probably get bought out by someone. Okay, so let's do the modern portfolio. Okay, try to get- So this is how I set it up and this is how you should do it. It took me years to figure it out. So the first thing I'm gonna do is I'm gonna start with the capital allocation. We got the origin here, this is the risk-free rate. This is the expected return on the portfolio. And this is the standard deviation of the portfolio. Okay? Okay. And then I go right here, and I do the market basket, and I go like that, and like that. Okay? You wanna make sure that this umbrella is above the risk-free rate. And you wanna make sure that this line is up like that, it doesn't go like that, it's gotta go like that. And then you add in the efficient frontier umbrella. This is 100% stock portfolio. This is 100% bond portfolio. Got it. And then what I would do here is go like that, and then like that, and then like that. And this is the utility curve 1, utility curve 2, and utility curve 3. So if you do it like that, your efficient frontier will look really good. And then I can construct these portfolios anywhere along the efficient frontier. These are all portfolios that I can actually construct. And any portfolio inside here, I can actually construct too. And what I would do is make sure you put in these lines. This is going to be expected return for stock. This is going to be the stock. Portfolio standard deviation. This is going to be expected return for the bonds. This is going to be standard deviation for the bonds. And then this is your expected return on the portfolio. This is where you want to be. And at that point, right here, is where you are going to your expected return on the portfolio divided by the standard deviation for the portfolio, which gives you your risk adjusted rate return. Risk adjusted rate return. At this point, you're gonna maximize the risk adjusted rate of return at that point right there. Okay?
Is that a Q?
That's a standard deviation.
Okay.
A Q looks like that.
Okay.
That's the quantity from the microeconomics.
And then these,
These are utility curves.
okay.
Utility curves.
How do
And investors
they change?
investors want to be here. High return, low risk. I can't construct a portfolio. There's no assets in the portfolio that's going to give my client high return and low risk. So what they have to do is they have to lower their utility to get to the point where their utility is tangent to to the capital allocation line and the efficient frontier. At that point, that's the market basket. That's basically the index. Okay, so I replicate the index, I can offer them the index, and the index provides a expected return at a given level of risk that's gonna maximize the risk-adjusted rate of return.
Would low standard deviation mean low risk and greater diversification?
Yeah, if I'm going this way, I'm getting more diversification. I'll get into that in a second. I'll show you that.
So what does 100% stock mean?
That's, all your money is in stocks.
Okay.
So you're
So
gonna have a higher return.
high return, high risk. And then here, all of your money is in bonds, low return bonds. And then this is somewhere in between. So if I'm a bond investor, and I'm willing to take on more risk because I want more return, then I can sell off my bond portfolio and start buying more stock. And if I really want higher return and I really don't care about risk, then what I'm gonna do is I'm gonna sell off all of my bonds and put all my money in stock, which is gonna give me the highest rate of return, but also the highest level of risk. Stocks are very volatile.
So is that everything on this, the water portfolio?
I'm getting all
There's more.
okay? Any questions on that? Okay, so the next thing you can do is you can actually jump off the efficient frontier and move up the capital allocation line by using margin in your stock account and using mortgage. On your real estate. You can actually extend this a little bit. So by applying the leverage, you're adding a significant amount of risk to your portfolio, but you're getting significantly higher rate of return. Because I can buy, I have $100,000, I can borrow $100,000 from the brokerage firm, I can buy $200,000 worth of stock instead of $100,000. So now I have more stock that I'm wielding. I'm gonna make more money if I'm right. This is your expected return on the leverage. And then this is your leveraged portfolio. You can also jump off the efficient frontier and move down the capital allocation line, which banks do, through the process of lending. And that's what banks do. So they lower the risk. You're lending, but they get extremely low return, but they don't care about the return, they care about reducing the risk.
Isn't it kinda ironic though, cause mortgage-backed securities are supposed to be really low
These are
risk,
not mortgage-backed securities, these are loans.
based on like derivative.
They're not based on, I'm not talking about mortgage-backed securities. Mortgage-backed securities are out here.
Okay, cause I got confused, cause you said banks lend money and.
Yeah, through mortgage.
Yeah.
Mortgages, so I'm a bank, you come to me, I wanna buy this property, I need a loan. The bank says, okay, I'll loan you money. If you default on the loan, I'll foreclose and I'll take the property. So it's a collateralized loan.
Low risk.
Same thing with the stock account. Go to the broker's fine, I'll lend you some money to buy more stock. Great. If the stock prices go down, I'm gonna give you a margin call. If you don't put up any more equity, I'm gonna liquidate your stocks to pay off my loan. So they're collateralized. Any more? Oof. Okay, so let's get to the next piece. So this market basket right here has changed over time. So 1920 to 1970, it was 70% bonds, 30% stock. From 1970 to 1980, it was 60% bonds, 30% stock, 10% real estate, direct real estate. research done by Innstate. Then from 1980 to 1990, market.
Sorry.
Those numbers might be a little bit off, but it's basically the same thing. 50% bonds, 30% stock, 10% real estate, 10% cash value, life insurance. And that's what the market basket became. And then 1990 to, let's say, 2018. It's close enough.
40 bonds.
40% bonds, 30% stock, 10% real estate, 10% cash value life insurance, and 10% alternative renewable energy. So this becomes, for the future, this is basically your model target portfolio. This is your future allocations. Yep.
So those last three things, those out the efficient frontier.
Yeah, these are alternatives. These are alternative assets right here. And why does the alternative assets bow out the efficient frontier? Because their returns have low, no, negative correlation with stocks and bonds. So if these are the returns on stocks and bonds, the alternative assets either have no correlation, negative correlation, or low correlation. So if you add these alternatives to your stock bond portfolio, it blows out the efficient frontier. Like that. Obviously, it's going to lower the expected return, but your portfolio risk is reduced even more. So by adding the alternatives to your stock bond portfolio, it's going to reduce the expected return on the portfolio, but it reduces the portfolio standard deviation even more, which increases the risk-adjusted rate of return. And if you can get your client annualized returns of 8 to 10%, you can double the portfolio in less than 10 years. And that's what the clients want. So if I can do this, and then I can add diversification, adding these, even though I get lower return, my risk is reduced even more. And if I can lock them in at 8 to 10%, then I can increase the risk-adjusted rate of return, and that's what the risk-averse investors want. And then you're in, and you can raise billions and billions of dollars. Now, the beauty of this model, too, that was really the modern portfolio piece where you can get the bowing out of the efficient frontier through diversification into alternatives. The other thing that's really amazing about this model is if you have life insurance, particularly permanent life insurance, mutual permanent life insurance, based on the principle, the individual, that if the individual passes, that the death benefit from the life insurance policy will be injected into the estate, and the beneficiaries will jack up onto a higher utility curve, which is where they wanted to be originally. But there was really no portfolios that could be constructed with stocks and bonds that were out there. But we can create a synthetic portfolio by applying the life insurance policy to create that wealth effect and the ability for the estate and the beneficiaries to get it onto a higher utility curve.
Because if the person died,
If the person
gets
dies,
that money.
then the money goes into the portfolio, and then it's handed over to the to the heirs. And the heirs want more money, right, than less money, right? So if you give them more money, people are happier, so they'll be on a higher utility. Okay. And then the other piece that kind of flows right into this too is the derivative trades, right? Because I can bow out the efficient frontier by applying the derivatives as tools, as portfolio insurance to the portfolio, and if I apply those derivatives correctly, it's also going to bow out the efficient frontier. But it's not going to be, the efficient frontier is not being bowed out through diversification. It's being bowed out through the application of the derivatives as tools to apply the portfolio insurance. So actually what we're doing is we're using financial instruments to bow out the efficient frontier, using financially engineered product, which goes right back to this.
And you can only bow it out towards the bottom where there's less risk.
Yeah, right here, it goes like that. So if I think that the prices are gonna go down, I can find indexes that track the asset prices and the returns in my portfolio. I'm obviously gonna be investing in ETFs, and I'm also gonna be investing in stocks. So if I think the values of the returns in my portfolio are gonna go down, I'm gonna write forwards, I'm gonna write futures, I'm gonna write calls, on futures, and I'm gonna buy puts on futures. For my ETFs, I'm gonna sell short,
Right calls,
I'm gonna write calls,
buy puts.
I'm gonna buy puts. And I'm gonna do the same thing for the stocks. And if I do that, the derivatives will be the tools to apply the portfolio insurance that will bow out the efficient frontier, the expected returns will go down, but the risk will go down even more, and I'll be able to increase my risk-adjusted rate of return using the financial derivatives as opposed to investing in the alternative assets. Okay, does everybody get that? Did you get that so far? Yes? No?
I'm getting a little confused with what the derivatives are.
Derivatives are just forward contracts
Okay,
are based on the index calculations,
okay.
measuring the movement in stock prices and bond prices and gold prices and those things. So I'm not buying gold,
And those
I'm not buying stock or bonds. What I'm doing is I'm using the indexes as the underlying
tools too.
to trade these contracts
Okay.
based on the indexes, based off of the market. So these just measure the market. So I'm just basically using these are a derivative of this in the market. So it's just a contract to basically bet on where you think things are gonna go. You're not buying anything, you're just buying a contract. And if you win, you get money. If you lose money. Okay? Okay? And then the other is, if you think for the derivative trades, if you think prices are gonna go up, you get the indexes, the ETFs, and you get the stocks. And these are gonna be the same. So if you think prices are gonna go up, you're gonna buy forwards, you're gonna buy futures, you're gonna buy calls on the futures. You're gonna write the puts. Futures. I think the prices are gonna go up. You're gonna buy on margin. You're gonna buy calls. And you're gonna write puts. And they're exactly the same. Stocks. So that answers the other question on here. Modern portfolio theory and then the trades. And then the derivative trades are also part of the modern portfolio theory. Okay. Keep going, we're almost done. You guys wanna take a picture of that?
The one part here at the bottom, I'm not sure, explain how this trade could hedge costs for a firm, or
Tom?
this part,
Explain how using these trades could hedge costs
Right
profit
here.
for a firm.
I'll make sure I got that right.
These are the hedges.
I
If
see.
you think prices are going down, then you apply these trades, you've hedged off your risk.
I see, I do it now.
So they're protection.
And then also the derivative trades as well, right?
Yeah, and they're also the derivative
Alright, I
trades.
just wanna make
But
sure I
it's
got.
just this one
I
that
think,
basically is also applied here to the bowing out of the fishing frontier.
yeah. So I just wanna make sure I got that right, because it's like there's three things, but only two, but yeah. Alright.
So, you know, these things build on each other.
Mm.
They're used in other problems. Did you guys get a copy of that?
So to understand, like, writing calls and puts and options and futures, you're not generating wealth from like a stock alone, you're making bets and taking other people's money and winning other people's money.
Yeah, you're just writing a contract thinking that it's gonna go up or down.
Okay, so that's a lot, okay, so it's more of a one-on-one than it is a group effort.
No, you do it through an exchange.
Okay,
So you're not doing any of this stuff between any individuals, you're doing it through an exchange. They provide standard, like I can buy a call option on Apple stock, if I think the stock price is gonna go up. I can either buy it, I can buy on margin, or I can buy a call option. I'd rather buy a call option, because I can take my $100,000 and buy more, I can buy more options to buy more stock using the option contract. So instead of $100,000 of stock on Apple, I can control $10 million worth of stock on Apple using call options. I'm just saying that's what the derivative contracts, they're powerful instruments that you can use, and if you know what the direction of the markets are gonna go, where the stocks are gonna go, you don't buy the stock, you buy the call options, or you write the put options.
How do you
Can we- Are you guys done with this? What you buy them through a broker, an options broker. I have a Series 7, I could sell an option.
and you don't.
We can come to you.
Yeah, but I'm not gonna sell them to you because you're not suitable.
I'm suitable.
So what about
You have
those
no
other,
you have no experience in trading options,
so
and
this,
you don't have enough money.
If I get 100% on this test, what's on it?
Huh? Huh?
Can I work with you if I get 100% on this test come Tuesday?
Oh, if you want to.
Alright, cool.
If you want to, I have some research projects I'd like to monetize. I'm always looking for somebody to work with me. That's serious. A lot of my students drop out at some point. They got other things to do. Okay, so what's the next one?
Have you technical analysis
Got it,
and
what?
charts and, have you sold your Apple stock yet?
No way. So,
You are,
no way, because I think it'll go up and probably split maybe 2 or 3 more times. So what's the next one?
Alright.
when analyzing.
Oh, the technical charts. Okay. So this is what I would do on these technical charts. Make a big chart. Okay. And you want to do this one like this. And you want to do this like this. And then this is the ACD, RSI. This is trading volume. And these are just momentum indicators. If you go to stockcharts.com, they will give you this. Okay, and then this is how I do it. Okay, if you guys wanna follow along, there's actually an art to this stuff. Okay? So what I do is I start like this, and what I do is I create a trading range right here. And then it will break out to the upside, get a shoulder, get a peak, another shoulder, here like this. Then the stock price will move down, trade into a little range right here, and it will drop, trade in a range here, and then you're done. That's Yahoo. Okay. And then the first thing you're gonna do, as you can see from the price charts, is this is gonna be your support line. This is your resistance line. Right here, this is the breakout to the upside. And as you can see, the stock price went up and down. It looked like it formed another support right here. It looks like it formed another resistance line here. It looked like it formed a peak here or a head. This is the shoulder. This is the shoulder. Got it. Looks like we have a breakout. To the downside. It looked like here was actually trying to form a support on the prior resistance. Okay. So this looks like another support. Got it. Oh, and then it broke out to the downside again. Oh, and it looked like it started to form another support based on the prior support. Before it broke out again to the downside. It looks like it was in a upward trend line. Looks like this is a downward trend line. And this, when the stock price is bouncing around like this, in this range, it's called range bound. The sideways pattern. Also trading sideways. It's also called an accumulation phase or consolidation. And then usually it'll bounce around for a while, waiting for new information to come in from the marketplace. And if the news is really good, it'll break out to the upside, and if the news is really bad, it'll break out to the downside. So that's basically it. And then there's just a list, right, of the trading techniques: momentum trading, Dow theory, Wyckoff theory, time series analysis, moving average crossovers, the list, you know, the different types of technical trading strategies. But that's kind of the chart that I'm looking for. And that's Yahoo. Oh, and then what you'll see also is during these sideways patterns, like when the stock price is going up, the volume will go up. And then when it starts to trade sideways, it gets really thin because there's no information. And then all of a sudden the news will hit, the volume will spike, the volume goes up, so there's more people selling, and it thins, and then more people are buying, and then more people are selling, and then more people are buying, and then people just start dumping the stock, and the volume goes off the charts. So you can use volume as an indicator for, you know, momentum. And then the RSI when the stock price is going sideways, it kind of goes like this. And then when it goes up, it goes like that. When it goes down, it goes up and down and up. And then when it starts to go down, it goes like that. So if I'm getting, lower volume and my RSI is going down, then I bet the stock price is going to continue to sell off. And the MACD is basically the same thing. It's just another momentum indicator at the top. So that's technical analysis. Okay, and then the last one is the intrinsic values. And those are pretty straightforward. So perpetuity. Okay. So we're looking at cash flow, T plus 1 divided by the expected return of the discount rate is going to give you using the perpetuity model. So it's next year's cash flow. This could be earnings per share, EBITDA per share, EBIT, earnings. You can use it to value companies or you can use it to value shares. But you're using next year's cash flow. And this could be the discount rate or the expected return. Okay. And then the Gordon growth, or constant growth. This one is the same, CFO T plus 1, I minus G equals the valuation using Gordon growth. So this one assumes that the cash flow is going to grow at a constant rate forever. This one up here assumes that this cash flow is going to remain constant or flat forever. Okay. And then the multiple approach. So the same cash flow plus 1 times the multiple, T plus 1 equals the value using the multiple approach. And the multiple, we're doing firms, be the sales price. The firm, what did the firm sell for? I'm doing high-tech firms. Whatever the company sold for divided by the EBITDA is going to give me the multiple. So if I know the cash flow, if I know my EBITDA for my company, and I know what firms have sold for, what their multiples are, I can take the multiple, multiply it by the cash flow and figure out the value of my company. I can also use stock price divided by the earnings per share. It's going to give me the PE. Just going to give me the PE multiple. And if I know what the future stock price is going to be and what the earnings per share is going to be, then I can come up with a forward-looking PE multiple. So if I know what my earnings per share is going to be for next year, and I know what my multiple is going to be for next year, I can figure out the value of my shares in the future. I can predict stock prices doing that. Okay, and then the last one is the discounted cash flow. DCF. I'm going to do a 2-period model. So we're going to calculate the present value in DCF. To get the first year cash flow, I need the cash flow, the current period, and draw it out at 1 plus G, and that's going to give me CFO T plus 1 plus I equals 1, CFO T plus 2, which is CFO T plus 1, 1 plus G. I'm going to round it out. Boom, I got it there. I'm going to divide that by 1 plus I to the 2. Okay, you guys follow so far?
What's the one plus G again with the CFO?
That's the growth rate.
So you add that to the.
Yeah, if I think it's going to be 3%, then it's 1 1.03. So I multiplied that by 1.03 to get it.
Oh, okay.
Multiply this one, today's by 1 plus g, to get this one, multiply it by 1 plus g to get that one.
And then you do the same thing with the term two?
Yeah, then I go 1 plus g, grow that one out, and I'm gonna get CFO t plus 3. So I gotta go one more year, but it's only a 2-year holding period. Okay. So what I'm trying to do here, by growing it out to here, is I'm gonna divide this by I. I think that the cash flow is gonna remain a constant, and I'm gonna get the terminal value. Or, if I think the cash flow is gonna grow at a constant rate, then I'm gonna divide it by I minus g, using Gordon growth. And that's gonna give me the terminal value. And then I take the terminal value, boom, I add it to the last year's cash flow.
And if that's higher than the present?
Nope, then I take the terminal value and I add it to the last year's cash flow. And then I discount it back to get the present value. And I discount this one to get the present value of the cash flows. And then I add them all up. Like that. So you always gotta carry it out one more year. And then if you think it's gonna be flat forever, you use perpetuity. If you think it's gonna grow at a constant rate, you use Gordon growth to get the terminal value. Then you add the terminal value. And then you get the discounted cash flow. Add them up to the present value. Okay. So that's basic. That's the theoretical mechanism. And then for the problems, I think the first one's pretty straightforward, discounted cash flow. You know how to do that in and out. First thing that I would do is on page 7, 8.1. It asks me to calculate the bond price. First thing I want to look at is the coupon rate to the market rate. So is the coupon rate higher or lower than the market rate? On 8.1, page 7.
Yeah, it's higher.
It's higher, so will the bond trade at a premium or a discount?
Premium.
Premium, so that means it's gonna, the price is gonna be higher than what?
One, or, the market.
Yeah, no. What are corporate bonds traded at?
1,000?
1,000, so it's gonna be higher than 1,000. Okay, so that's the first thing you wanna know. Okay, and then you just apply the formula. And then on the next one, the yield to maturity. Again, the first thing I wanna look at on that one, on page 8, problem 810, is the bond trading at a premium, par, or a discount?
Discount, I think.
At a discount. So is the market rate higher or lower than the coupon rate?
Higher.
Exactly, so it's gonna be higher than what? 6%. And then they say down here, try 10.
Oh, so that's why you try 6.6 after
So you
just
do,
6%.
so you do 6, you do 7, you do 8, you do 9, you do 10, and then when you get to the 10, right, it's gonna, the present value, the coupons and the present value of the future cash flow, it's gonna equal $868.43.
Okay.
So you just take it up until the present value equals the price, and whatever the discount rate is, that's your yield to maturity. But you can use the, I just want you to do one interpolation on it, I don't care what you use, just it's gotta be greater than 6. And then you could use the calculator, you know, to calculate that pretty quickly. Okay, so it's just getting you used to the bonds. And then the other ones are just easy, right, they're pretty simple. Okay, and that's it. And if you, and this is the hardest part. If you get through this, it's a lot easier.
We'll get to it.
Yeah. Or I give it to you up front.
Thanks for taking the time.
Or do I just
Go over.
trickle it out to you over the semester as like little needles? Just needle you, and then this is what usually happens. And then at the end of the semester, it's like a week before finals, and my students go crazy.
Yeah.
They literally go freaking bonkers. They're in tears, and yelling at me. So I decided I'm not going to do it.
You always say why.
What?
They're yelling at you.
Because they're having a nervous breakdown. because they took 7 classes, and they work and play rugby, and, then, play golf and stuff. They're just stressed out.
Dr. Susan,
Yeah.
this is extra credit if we, bring in the blue book. where-
Yeah, and that's now your study guide.
Right,
Yeah,
yeah,
yeah, totally.
okay.
And when we're gonna review this.
And then you have 2 days to do it, and just do the best you can, and then I'll take a look at it, and if you need more time, I'll give it back to you, and you'll go back.
Sounds good.
But I just wanna see what you can, how much you can retain.
Yeah.
Do you check anything after the first day, or do you just give it right back second day?
So the test scores.
What do you mean? I'm not gonna do it, I won't look at it.
Okay,
I won't look at it until it's, you hand it in with the day.
And then
Thursday, okay.
Yeah, because you got plenty of time on Tuesday night and Wednesday and Thursday morning to come in and correct it and do stuff.
Okay.
So I'm not gonna look at
Thanks for your time.
it. All right, you're welcome.
See you tomorrow.
Thanks, Dr.
Do you
Susan.
guys like cheesecake and ice cream pie?
I'll be all loaded up on Saturday, so.
No, you're gonna, I'm gonna force you to do that.
Alright.
Have a thing, as always. Peace, Martha.
on, Brady. Let's go.
Oh, camera?
Yes.
Stop.